as we approach the third decade of the 21st century, at least I can hardly remember in my 25-year career in banking a more challenging time for the financial services industry. A series of geopolitical risks, from the erratic trade war between the US and China and remaining ambiguity over Brexit, to tensions in the Middle East, Hong Kong, and now recently Chile, that have created an extraordinary situation that is not only very difficult to predict, but also bears the risk of volatility in the financial markets. And it's already obvious that these uncertainties are beginning to impact world economy. After a decade of global growth, there are clear signs of a slowdown. In some major economies, the warning bells of a recession are ringing, and that does include Europe. But the biggest challenge facing the European financial services industry is the persistent and structurally low interest rate environment. For more than 5 years, the euro has experienced the extraordinary situation of not just low but negative interest rates. Regarding their economic objectives, negative rates are no longer likely to be effective. With fears of a downturn mounting, we have reached a level where monetary policy is at serious risk of running out of means to cushion a real economic crisis. Most economists are skeptical that further interest rate cuts or further bond purchases can significantly support the economy. And let me tell you, when talking to our clients, not one of them has said that because of an additional 10% rate cut, they would now suddenly start investing what they may or may not have done before. At the same time, negative interest rates are a burden on the financial system as they turn long-standing certainties upside down. One example, bonds with a volume of over 10 trillion euros are showing negative yields worldwide. And with the European Central Bank's unprecedented monetary policy experiment, a sizable number of them stem from Europe. And it's absurd to some degree. Fixed income securities are now traded like equities. You buy them because you expect further increases in value and not because you expect a reliable fixed return. Cheap money drives up asset prices, from shares to real estate, fueling the redistribution of wealth in favor of the asset-owning affluent. This is made worse by the simultaneous damage that negative rates do to European savers, who our economists estimate are foregoing 160 billion euros a year in lost interest. With inflation factored in, the result is a creeping erosion of our European customers' assets, and this doesn't in any way take into account yet the wealth destruction in the pension systems. At Deutsche Bank, we believe it's our duty to help prevent this by encouraging all clients, but particularly our retail customers, to review their cash holdings and consider switching from zero interest rate bank deposits to higher yielding assets. However, not all clients will want or be able to make this shift, which triggers the question of what happens to those who retain deposits on their accounts. Across the industry, the dilemma of whether and how to share the burden of negative rates with clients is likely to intensify.